Recording, lecture. Okay. It is about so I hope that you all can see the screen. Okay. Reflection of individuals to financial reporting and examination of behavioral research in accounting. So we will basically talk about behavioral research in accounting. I think when you chapter 11, I think recommended text based on this particular book, we are really delivering this lecture. Here really, when you look at the behavioral research in accounting, the idea, accounting is basically, information, communication, reporting. So when you say behavioral accounting, we are just bringing, machine can produce information, but how to interpret, how they use, what value they assign for this information. For example, how do you look at the financial statement? How do you perceive the total assets, total liability? So thereby, our perception, our psychological, interpretation for accounting will be discussed under behavioral research in accounting. So thereby, it's a kind of human involvement. So we are bringing the human involvement into the accounting. So that is behavioral research in accounting. So outline, of course, introduction to behavioral research in accounting, branches of behavioral accounting, then the Brunswick lens model, and also limitation of behavioral research. Will be the scope of our, we will be discussing these areas. Then the learning outcome, explain how behavioral research differs from capital market research. So when you look at the capital market research, we'll discuss it. Basically, capital market research is basically, you focus on capital market information from a database. You may investigate whether the particular item will have an impact on share prices. What would be the corporate governance and the capital market relationship, something like that. So those are the capital market research. I think you discussed this. What happened in behavioral research, you bring the human elements, behavioral aspect, sociology, psychology, political aspects into the accounting method. That is how behavioral research. Explain how different accounting related variables can be manipulated in behavioral research. So manipulation side, discuss how the results of behavioral research can be of relevance to companies and the accounting professions for anticipating individual reaction to accounting information. So thereby, so we will be discussing the human involvement in relation to disclosure. Assess how the results of behavioral research can form a bias of developing ways to use accounting data more efficiently. Then the assess limitation. What is behavioral accounting? Basically, behavioral accounting is, trying to figure out how do people make decisions, So what they do with this accounting information, basically we are handling. How do people use accounting information in making decision, how they are going to use it, is the behavioral account. So thereby, this is so we focus on this in this way, I think. Okay. Yes. So when you look at the behavioral accounting is the matter what we discuss. As I told you, basically it's trying to figure out how do people make decisions. So thereby we are bringing the people element, human capital into this particular accounting. And behavioral accounting research is, of course, focusing on you see the focus on how do people use accounting information in decision making. For example, how investors look at net profit and total assets. So that is one example. So thereby psychology and how people biases might affect their decision making. So psychological matters, your mental position, your cognition process, and how people bias will have an impact on decision making. How governance of a corporation might actually be impacted by the behavior of the individual. So another area would be, governance. Another example. Really, these two are example for behavioral research. These two, how investors look at net profit or total assets, how governance of a corporation might actually be impacted on behavior of the individual. So thereby, you see, for the behavioral account, psychology and how people biases might affect their decision. So that's about the basic introduction. I thought of initially giving some example for behavioral accounting, how auditors trust in other people affect amount of reporting, evidence, and certainty about intentions misstatements. Auditors tone at the top, mentality affect the audit judgment and improves the quality. So those are some example of, you see, always, we will look at the human, we will try to bring the human aspect, into our investigation. So thereby it's called behavioral accounting. So that is the idea of behavioral. That is the basic introduction of behavioral accounting. You can read all these, just take few minutes and just look at the research papers or the research title I have taken from the web. Okay. So thereby you may talk about accounting. When you talk about the accounting, you maybe talk about behavioral accounting from the perspective of budgeting. Here, the last one, maybe control mechanisms, maybe financial reporting, financial statements, financial accounting, decision-making tools, for example. So those are the areas of behavioral accounting research. Then based on the text, what we are trying to do is behavioral accounting research examines how individuals react to various accounting disclosures. So maybe budget information, maybe financial statement, maybe cash flow statement, performance reports, KPI indicators, control, balance scorecard, even what do you call this, standard costing. All these are accounting disclosures, but you may discuss the accounting disclosures in financial reporting. That is the disclosure on the face of the financial statement and disclosure on the face of the financial statement and disclosure as additional notes. So those are coming under financial accounting disclosure, but we are talking about here accounting disclosures, even budgeting, balance scorecard, KPI, performance indicators, standard costing, etc. So thereby, so behavioral accounting is, it examines how individuals react, how they perceive, whether they really making a bias, narrow decision based on accounting information, whether they look for more information, are they believing in auditors' judgment, are they believing in auditors' report, so something like that. Then it makes no assumptions of how people behave, but to discover why people behave as they are, as they do. I think you can remember the economics model. In the economics model, we assume that individuals are behaving in a rational way to maximize the utility. So thereby there are assumptions. What is the assumption? Assumption is to maximize the utility. Or you can say maximize the profit from accounting perspective. So there we assume that human beings or individuals are behaving in certain way. So all economics model, economics theories are based on that particular. But here we don't make such assumptions. We look at how people really behave, what they are doing with the accounting information, how they tackle the information, how they take information, how they take decisions, what is the decision process involved with by using this kind of information. So that's basically, there is no assumption. We go to the we talk to the people and we try to find out why people behave as they do, why people behave in such a way, the reasons, the psychological, social, political reasons we are trying to find out, we are trying to study under this behavioral account. Applies theories and methodologies from behavioral science, not from economics. We use the behavioral science to examine the interface between accounting information and process of human behavior. So it's really examining the interface between accounting information and processes, and accounting information and processes and human behavior. So thereby it's a kind of accounting is really, now we are brought into the, we are looking at the accounting from the behavioral science perspective under behavioral research account. Then we'll move on to the next slides. We have the capital market research and the behavioral accounting research. So capital market research, I think last week you discussed with your Dr. Chaturika, and it talks about the aggregate investor behavior, the behavior, the market behavior. But here, when you talk about behavioral accounting, you are not talking about the market as a whole. We talk at the individual level, maybe even group level, how professional accountants behave, how non-professional accountants perceive the accounting disclosure, financial reporting, etc. So thereby, here it's like macro level. Here, behavioral accounting research is micro level. Movements in share price around the time of particular events. So it's, you talk about the share price movements, how accounting related decisions differs in different situations, place, senses, and time. So the one set of information, for example, may look at audit, for example, say not investors, how investors look at financial information in a context where developing countries, how investors look at really the information in a developed countries. So it may vary from place to place. People's behavior will vary from context to context, situation to situation, place to place, and time to time. So thereby, it's basically situational and more micro level. behavioral accounting. Here it's aggregate. In general, you will talk about capital market research. So thereby there is a difference between, for the capital market research, archival data, you may use the archival data, published data in the Colombo Stock Exchange. But for a behavioral accounting research, you are not using archival data. You may much more focus on talk to people, doing survey and getting a question, right? Then behavioral accounting, grounded in branch of psychology called behavioral decision theory, which has its two roots in psychology, sociology and organizational theory. Behavioral decision theory has two interrelated phases. So behavioral theory focus on psychology, behavioral, sociology and organizational theory, maybe contingency theory. Normative. Normative means, normative means we talk about in normative research what has to be. So thereby prescribes. For example, if you take Sri Lanka accounting standards, IFRS or IFRS, then all these are prescribed. If you take property, plant, equipment standard, it prescribes what to do. If you take intangible assets, it prescribes what to do. If you take fair value accounting standards, it prescribes how to do the fair value, how to calculate the fair value, how to measure how to take the fair value. So thereby prescribes. So behavioral accounting research may have one branch which is prescribed courses of action that confirms close to decision makers' beliefs and values. Right? You prescribe, you expect, but when you go to the real life situation, for example, we say that financial reporting or the financial statements can be used by the investors to decide whether to hold or whether to really invest or whether to sell a particular, dispose a particular investment. So what we are trying to do is investors or an investor can take decision about investment in equity or investment in debt by looking at the financial statements. Profit and loss income statement, comprehensive income statement, financial position, cash flow statement, additional notes, and referring to that, even annual reports. But reality may be not the case. Reality may be investor may not use the financial information or the financial, they are not analyzing the financial statement to finalize their investment decision. So you see that the normative understanding and descriptive understanding. So thereby the behavioral research has two interrelated phases. One is normative, other one is descriptive. Describes beliefs and values, the manner in which individuals incorporate these into their decision. You describe how individuals are taking decisions. You describe how investors are making their investment decisions. You describe how professional auditors finalize their audit opinion and audit judgments. You describe how practicing accountants decide materiality judgment. But as per the accounting standards, you may have prescriptions to decide the materiality. Even for auditing standards, auditors, there are guidelines describing what to do, how to decide the materiality level. But in practice, when it goes to implement real life situation, you see it's different. So thereby you can describe what is there in real situation. Use of BAR, that is, the answer the question, to answer the question how people use and process accounting information. So you are trying to answer how people use and process accounting information. Provide useful insight into the way different types of decision makers produce, process, and react to particular items of accounting information and communication methods. You may study how professionals react to financial report, how non-professional mean non-accountants, how engineers use financial related information which is published in the annual reports. So thereby provide useful insights into the ways of different types of decision makers. So thereby what do you call this behavioral accounting research will help us to understand different groups, different individual, uh, 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 how they react really, how different individuals react to accounting information, how different individual react to earning per share, how different individual reacts to the governance mechanism. So thereby, use of behavioral accounting research is basically to understand how people, how individual, tackle the information, how they use information with regard to their decision making. Provide useful information to accounting regulators, which accounting methods and what types of disclosure will provide useful information. So according to the accounting standards or whatever the theory in accounting techniques, we provide information. Maybe for with regard to the financial accounting, we provide information to the regulators. So with disclosures, so it's there. Then, of course, when you have understanding about how they react, how they use accounting information, what we can do is we can modify our normative prescriptions. So if you know really what is happening in the ground, if you know really how individuals are reacting for accounting informations, so finding of this accounting research can be used as given in the this bullet, just to improve the communication, just to improve the reports, just to improve the format of financial statement, just to update, just to revise the accounting standards, etc. Or just to provide a new accounting standard, just to introduce a new accounting standard. So thereby, I think behavioral accounting research may be useful, much more useful for the, especially to the regulators and information providers to change, to update, to revise their prescriptive forms or standards. Then branches of behavioral accounting research. So there are different branches, of course, branches of school of behavioral account. Managerial control. Some may really look at from the, managerial control. For example, how auditors react to weak accounting controls or internal controls or management controls. For example, how auditors really, how practitioners or the investors react to the performance indicators. It's a kind of managerial control, performance. Then accounting information processing. Processing means the how they process, how really practitioners or preparers of financial statement look at the materiality. How do they really take the decision of material judgment? Because, as per accounting standards, to increase the, to inbuild the fundamental characteristics, what is essential is to inbuild the materiality, provide all material information in the financial statements. So thereby, process of deciding materiality, I think maybe, a kind of accounting information processing. Or how really people, adopt what kind of perceptions people really adopt in introducing, new standard, maybe leasing standards, etc. Accounting is information system design. So you know that maybe IT system, maybe some a new system to cater for the new accounting standard. So thereby deciding the stage also, you may talk about, you may use behavioral accounting research. The other one is auditing process research. As I told you, how auditors decide the materiality level, what are the perception values, what kind of other related information they will use when designing the materiality level, and how auditing process take place in your organization, and also organizational psychology, how people really think about, accounting matters and organizational cases. You can use the organizational theory for organizational sociology. So those are the branches of accounting research. Then we will come to the Brunswick lens model used to explain behavioral research. That particular model, perspective about the environment are generated through a lens of imperfect cues. Imperfect cues. Perspective about the environment are generated. Okay. Then statistical model. So you have to remember the behavioral accounting research not coming under the qualitative, it's coming under the quantitative. So thereby you use statistical models. When you use the statistical model, obviously you need the independent variable and dependent variable. Otherwise, you can't apply the statistical, tools. You have to measure the variables. You have to measure the concepts, what you are going to study under your behavioral accounting research. So cues independent variables to the criteria event success dependent variable and independent variable. Are you clear about this Brunswick model? He talks about cues. He talks about left-hand side and the right-hand side. Lens perspective about the environment are generated through a lens of imperfect cues. So now, since you are in an environment, there are, environmental factors which decide your output, The simple lens model, you have the cues, environment, different events taken place in the environment, and how you really interact, how you respond to these particular event is the question. So your environment, in the environment, events are taking place and people are there. We call it decision makers. How you are going to really, how you are going to make information to take a decision. For example, predict loan default or non-default. So you just want to evaluate whether this particular loan, right, will be successful or not. Default or non-default. Say you are a banker, you are a credit manager. What criteria you will use to decide whether the loan would be successful or not? So that is maybe liquidity. You might take leverage, profitability, management evaluation, outside credit rating. You see, outside credit rating. That means others' statement. You see, these factors are really cues. So by looking at these factors, judgment most likely estimate of success. But your judgment is whether it is default or non-default. Actually, the success depends on how you perceive, how you assign, how you look at these cues. So thereby, in behavioral accounting research, we just identify the variable. Okay. Then Brunswick-Lens model, as I told you, right-hand side of the model and left-hand side of the model, environmental side, and the right-hand side of the model, the out. The relationship between the actual phenomena or event and the particular cues provided. What is the relationship? For example, what is the relationship between profitability and the success of the law? What is the relationship between, liquidity and the success? What is the relationship between credit rating and the success of the law, default or non-default? So this, therefore, here you focus on, much more environmental side. Here, how individual uses cues to make an ultimate decision about the issue under investigation. How they are going to use liquidity? Are they giving high significant importance, or are they giving much more weightage to the liquidity, or are they giving less weightage to that one, or moderate, or ignore it? Even though information are there, you ignore the liquidity. Even though profit figures are there, you ignore. You just look at the credit rating of others. You just look at the, what do you call this, credit rating information. Now, when you go to the bank, I think bank will check your credit rating. So if you are in that particular list, blacklist, I don't think that bank will give you a loan. So you are blacklisted, no loan. For example, suppose you go for you are unable to pay your credit card. What do you call the amount? Then you will be blacklisted. So just because of inability to pay your credit card due to a short-term decision, due to a particular small minor reasons, if the bankers are telling no, you are in the list, we are not ready to offer you the loan. So that is, you are using information in a not in a broader way. That's in a narrow way. Is it? I think so. Thereby, right-hand side of the model is important. How you use it, how you make the decision by using it. That is the idea. How and whether particular cues are used in decision making is particularly relevant to the accounting professions. If information items in financial statements are not used, then they could be deemed not material and thus not required in disclosure. We don't use financial statement to make decision, investment decisions. That means these are not material for the users, not relevant. Okay, the accounting profession is also interested in whether presentation impact the decision. That is the input level. Inputs are cues. How we are going to use it. If you are not using it, it's not relevant. So thereby accounting professions, maybe accounting standard setters, maybe CA Sri Lanka, maybe International Accounting Standard Board is interested in knowing how users really look at the particular information. For then it is easy for them to modify, update, change, revise their accounting standards and recommended practices. Decision-making process, study have examined how the various cues are weighted. Judgments have been found to be consistent over time. Decision makers also have been found to be employed simplifying heuristic when making decisions. What is heuristic? Okay, shall we just look at a video? I don't know whether you can hear. I just want to communicate you the meaning of heuristic. I am going to play a particular video. I don't just see whether you can. Just see whether, can you hear? And oftentimes, will you just confirm whether you can hear the video and see the video? Okay, good. This must be made in the face of uncertainty. Heuristics and biases. This paper first. The paper examines three heuristics representative of the we first examine representatives to overestimate the communities and accurately predicting the likelihood. It very helpful for detail. Based on that description, you think that a librarian or a physician. In scenario here you will understand now representation is something like stereotype based on available information and similarities. We just jump into the decisions, maybe based on the particular guy, shy and helpful, little interesting people, you know, neat and tidy and order, structure and detail. So thereby you may decide he's maybe a librarian, but you have to understand in certain cases, even though farmer, when you look at a farmer also may have this kind of characteristics. So thereby heuristics, when you make decision based on heuristically, I think it's narrow. That's what the first representation.
Each group was given 5 seconds to estimate performance. The group was given the following. The second group was given in the reverse order. Do you think that both groups arrived at school? The first group to eat 1,200